Europe did not wake up to a crash, a warning, or a single headline announcing disaster. And that is exactly why this story is easy to miss. Cities are full, businesses still operate, governments function, and daily life continues with the appearance of normal stability and control. Yet beneath that surface, something important has been quietly changing inside Europe's economic foundations for years. Instead of attracting fresh capital at scale, Europe has slowly become a place money passes through rather than commits to. This is not because Europe collapsed, failed, or lost relevance overnight, but because incentives have been quietly shifting. Large investors do not leave dramatically when confidence fades. They reduce exposure slowly to avoid attention and resistance. Trillions are not pulled out in one move, but redirected elsewhere through decisions that look technical and boring on paper. To most people, nothing feels broken, which makes the shift feel unimportant and easy to ignore. But capital leaving quietly is more dangerous than capital fleeing in panic, because it reshapes the future without triggering alarms. For decades, Europe benefited from predictable rules, deep markets, and a reputation for long-term stability. That reputation attracted global money looking for safety, diversification, and steady returns, rather than explosive growth. Over time, however, stability turned into rigidity, and predictability began to feel like stagnation. Growth slowed, innovation scattered, and investment returns struggled to justify the complexity and cost of operating inside the system. At the same time, other regions offered clearer incentives, faster decisions, and fewer long-term constraints on capital. Money did not judge Europe emotionally. It compared options and quietly chose alternatives that felt more flexible. This process did not require announcements, because announcements would have invited political debate and public anxiety. Instead, capital adjusted silently, one allocation at a time, while official numbers continued to look acceptable. Europe did not lose trillions in a visible crisis. It lost them in opportunity cost and future commitments. Factories were not shut down overnight, but new ones were built somewhere else instead. Jobs were not erased instantly, but fewer were created where they once would have been. This is how slow exits work, not by destroying the present, but by shrinking the future. And that is why this story matters more now than it would during a loud financial panic. Because when money stops choosing a place for growth, that choice echoes for decades. Europe still looks stable, still feels orderly, and still believes time is on its side. But capital is already acting as if the clock is ticking. And once that belief spreads, reversing it becomes far harder than noticing it too late. That is the quiet problem Europe is facing right now. For a long time, Europe did not need to compete aggressively for capital because investors came automatically, trusting the system and its stability. Money flowed in not because returns were exciting, but because Europe felt safe, predictable, and unlikely to surprise anyone in a bad way. That worked well in a world where growth was global, trade expanded easily, and political decisions moved in roughly the same direction. But slowly, the environment changed, and the old advantages stopped working the way they once did. Growth outside Europe became faster, simpler, and more rewarding, while Europe itself became more complex and slower to adapt. New projects took longer to approve, rules became harder to navigate, and uncertainty increased around long-term returns. None of this felt dramatic to people living inside Europe, because daily life remained comfortable and familiar. But investors do not measure comfort. They measure future potential and how easily plans can be adjusted when conditions change. Over time, Europe started to feel less flexible compared to other regions that could move faster and take clearer risks. Capital began asking a quiet question: why commit here for 10 or 20 years when other places offer fewer obstacles? At the same time, energy costs rose, demographics shifted, and political compromises became harder to reach across countries. These pressures did not break the system, but they made it heavier, slower, and more difficult to change direction. For large investors, Slow systems are risky systems because mistakes take longer to fix and cost more to reverse. So instead of leaving loudly, money began choosing other destinations first when new decisions were made. Europe was not abandoned, but it stopped being the default answer when capital looked for its next long-term home. That distinction matters because defaults shape outcomes even more than dramatic exits. When a system stops being the first choice, it slowly loses momentum without realizing it. This is why Europe's problem does not feel urgent, even though its effects are already spreading. Nothing collapsed, nothing failed, and nothing forced immediate change. But capital began planning for a future where Europe played a smaller role in growth, and once planning changes, behavior follows quietly and consistently. That is how Europe started losing trillions without ever seeing them leave. Europe still looks successful on the surface, which is why this shift is so difficult to notice while it is happening in real time. Cities remain busy, infrastructure works, public services function, and nothing about daily life suggests that something fundamental is changing. But capital does not judge systems by how they look today. It judges them by how rewarding commitment will be 10 or 20 years from now. When investors stop committing long-term, the present can stay calm while the future quietly becomes smaller and more limited. Europe did not lose factories overnight, but new factories increasingly opened somewhere else instead of inside the system. Jobs were not erased suddenly, but fewer new opportunities appeared where they once would have formed naturally over time. This creates a strange situation where nothing feels broken, yet progress feels slower and harder to achieve for ordinary people. Careers stall, costs rise, and effort brings smaller rewards, even though no single cause is easy to point to or explain. These experiences feel personal, but they often come from investment decisions made far away, years before the effects are felt. When capital avoids long-term commitments, innovation slows first, and risk-taking disappears quietly from the system. Safe choices replace bold ones, and protecting what already exists becomes more important than building something new. Europe became very good at preserving stability, but stability without renewal slowly turns into stagnation. This is not collapse or failure, but it is a trade-off that compounds quietly year after year. Every year without strong new investment narrows the range of future options available to the system. The economy keeps working, but it works harder to achieve less progress than it once did. That gap between effort and reward slowly erodes confidence, even if people struggle to explain why. Governments respond by managing expectations instead of restoring momentum through structural change. Businesses adapt by focusing on survival and compliance rather than expansion and experimentation. Workers adjust by prioritizing security over ambition, even when they would prefer to take risks. None of these responses are irrational on their own, but together they lock the system into a slower path. This is how economies drift without collapsing and why the danger remains invisible for so long. Europe still looks fine, which is exactly what makes the problem difficult to confront openly. Because when the future shrinks quietly, there is no single moment that forces everyone to pay attention. And by the time the pattern becomes obvious, reversing it costs far more than preventing it ever would have. That is the hidden cost of capital leaving without making a sound. For many years, Europe made a quiet trade-off that felt reasonable at the time, choosing comfort, protection, and predictability over speed and experimentation. Rules were designed to reduce risk, protect existing industries, and prevent sudden shocks that could threaten social and political stability. This created a system where failure was discouraged, but so was bold success, because changing direction became slow and expensive. At first, this felt like wisdom, especially compared to boom and bust cycles elsewhere that caused visible pain and disruption. But over time, avoiding short-term pain also meant avoiding long-term breakthroughs that require risk, patience, and uncertainty. New ideas took longer to approve, new businesses faced higher barriers, and large projects required endless negotiation across borders. None of this stopped growth completely, but it lowered its ceiling and stretched timelines far into the future. For capital, time matters almost as much as returns because delays increase uncertainty and reduce flexibility. When investors compared Europe to faster-moving regions, the difference was not ideology, but friction. Europe offered safety, but safety came bundled with complexity, higher costs, and limited upside. That combination works well for preserving what already exists, but poorly for building what comes next. As global competition increased, capital became less willing to accept those trade-offs by default. Money did not leave because Europe was hostile or unstable, but because it felt slow to respond to change. Comfort became a feature for residents, but a constraint for long-term investors planning decades ahead. This gap between social priorities and investment incentives widened quietly without open conflict. Europe continued optimizing for fairness and protection, while capital optimized for adaptability and speed. Neither side was wrong, but they were no longer aligned in the same direction. When incentives diverge, systems lose momentum, even if everything still functions. This is why Europe's challenge is subtle and hard to address through simple reforms. Changing incentives requires accepting more uncertainty, which is politically difficult in stable societies. So the system adjusts slowly, absorbing pressure, instead of transforming itself. That choice preserves calm today, but narrows possibilities tomorrow. And capital responds accordingly, not with anger or judgment, but with quiet distance. This is how comfort can slowly replace momentum without anyone voting for that outcome. By the time the cost becomes obvious, the habits that caused it are deeply embedded. That is why Europe's situation feels confusing rather than alarming. Everything works, yet something essential feels missing, and that missing piece is future momentum that cannot be easily recreated once lost. One of the most misunderstood parts of capital movement is the belief that money always returns once conditions improve, but history shows this is rarely true. When large investors change long-term plans, they redesign strategies, supply chains, and expectations around new centers of growth and stability. That process is slow to begin, but once completed, it becomes very hard to reverse without extraordinary incentives or structural change. Europe is facing this problem now because capital did not just pause, it quietly built alternatives elsewhere that no longer depend on Europe. Once factories, research centers, and financial hubs are established in new regions, returning requires admitting past assumptions no longer hold. Capital prefers consistency over promises, and systems that already adapted feel safer than systems asking for patience during reform. This is why even strong policy announcements often fail to reverse long-term capital drift once it has settled into new patterns. Investors remember friction more clearly than stability, and friction lingers in decision-making long after headlines fade away. Europe's challenge is not convincing money that it is safe, but convincing it that future effort will be rewarded more here than elsewhere. That is a much harder argument to make in a world where alternatives already exist and are functioning without major disruption. As a result, capital behaves cautiously, maintaining presence without deepening commitment or expanding long-term exposure. This creates an economy that looks stable on the surface but struggles to generate momentum beneath it. The system does not collapse, but it slowly loses its ability to surprise on the upside. Opportunities still appear, but they are smaller, slower, and more competitive than before. This is the quiet cost of capital leaving without drama or public debate. It changes what feels possible long before it changes what is visible. And once that perception shifts, Restoring confidence becomes a generational task rather than a political one. That is why Europe's situation cannot be solved quickly, even if everyone suddenly agrees on the problem. Capital already made its choice quietly, and it rarely revisits decisions made at that scale without necessity. This is how long economic eras end, not with a crash, but with a gradual narrowing of ambition. Everything still works, but fewer futures remain open than people expect, and that realization usually arrives much later than the decision that caused it. Europe did not experience a crash or a dramatic warning, which is why most people never noticed that something important had already started changing. Cities stayed busy, businesses kept working, and everyday life continued normally, creating the feeling that the system remained stable and reliable. That surface stability created comfort, and comfort made it easy to believe the future would eventually correct itself automatically. But while the present stayed familiar, long-term decisions quietly began shifting away from Europe without any public debate. Money did not rush out in panic. It simply stopped choosing Europe when new factories, offices, and investments were planned. Nothing was taken away from the system, but fewer new commitments were made inside it than before. This is how trillions disappear quietly, not through exits, but through decisions that are never made at all. For decades, Europe attracted capital because it felt predictable, orderly, and protected from sudden political or economic shocks. Investors accepted slower growth because trust in the system itself felt valuable in an uncertain global environment. Over time, however, stability slowly turned into rigidity, and rigidity made future rewards harder to justify. Rules multiplied, approvals slowed down, and changing direction became expensive, complex, and politically difficult. None of this felt dangerous because danger is loud, while this process was calm and well managed. Capital began comparing Europe not to collapsing regions, but to faster systems that could adapt more easily. When effort increased but long-term returns did not, commitment quietly shifted elsewhere. Money did not reject Europe emotionally, it simply stopped defaulting to it when choices were made. That difference matters because defaults shape the future more than dramatic exits ever do. As fewer long-term projects arrived, momentum slowed without breaking anything visible. Jobs still existed, but fewer new opportunities appeared where growth once created them naturally. People felt this as pressure, even if they could not clearly explain where it came from. Governments responded by protecting stability instead of restoring momentum, because stability felt safer. Businesses adapted by focusing on compliance and efficiency rather than expansion or experimentation. Workers adapted by choosing security over ambition, even when ambition still existed. Each decision made sense on its own, but together they narrowed future possibilities. This is how systems drift without collapsing, and why the danger remains invisible for so long. Europe still looks fine, which is exactly what makes the problem difficult to confront. Because when the future shrinks quietly, there is no moment that forces everyone to look up. And by the time the pattern becomes obvious, reversing it costs far more than preventing it ever would have. For a long time, Europe relied on the belief that investors would always stay patient because the system felt reliable, predictable, and unlikely to create sudden negative surprises. That patience worked when the global economy expanded quickly, allowing Europe to grow slowly without feeling left behind by faster and more aggressive regions. Over time, however, patience stopped being a virtue and quietly turned into a cost, especially as other regions began offering faster decisions and clearer paths to returns. Investors started asking a very simple question: why wait 15 or 20 years here if similar projects could deliver results much sooner elsewhere? This question was not political or emotional, it was practical, and it quietly changed how new capital was allocated around the world. Europe was not rejected or abandoned, but it stopped being the default option when long-term plans were made. That difference matters more than dramatic exits because defaults shape the future without creating visible conflict. Existing investments stayed in place, but new factories, research centers, and headquarters increasingly appeared outside Europe. These decisions rarely made headlines because they looked like normal business choices rather than warnings about systemic change. Over time, however, those choices added up and slowly shifted where growth and opportunity were being built. Regions that attracted new capital gained momentum, while Europe relied more heavily on what already existed. This created a growing gap between systems building the future and systems focused on managing the present. Europe became very good at protecting stability, but less effective at generating new momentum at scale. Capital noticed this shift early because it tracks direction and incentives rather than promises or intentions. Once direction feels uncertain, long-term commitment quietly decreases, even while surface stability remains. This is why Europe can look calm and functional, while momentum slowly drains underneath. The system continues working, but it stops surprising on the upside and starts managing expectations instead. Growth becomes something to defend rather than something to actively pursue. At that point, waiting no longer feels like a strategy, it feels like a risk. And when investors stop waiting, the future begins forming somewhere else. That was the moment Europe quietly crossed, without debate, headlines, or public awareness. For many years, Europe treated stability as its greatest strength, believing that predictability alone would always attract capital and long-term commitment. Rules were designed to prevent shocks, protect workers, and avoid sudden change, which made daily life feel orderly and secure. At first, this approach worked well, especially after periods of global turbulence when safety mattered more than speed or innovation. But over time, protection quietly became friction, and friction made it harder to adapt when the world began moving faster. New ideas took longer to approve, large projects required endless negotiation, and even small changes demanded complex compromises. None of this felt dangerous, because the system continued functioning and people were shielded from short-term pain. But capital does not reward comfort, it rewards systems that can adjust quickly when conditions shift. As other regions simplified decisions and accepted more risk, Europe kept adding layers meant to prevent mistakes. Those layers reduced volatility, but they also reduced flexibility and slowed down long-term progress. Investors noticed that once a decision was made in Europe, reversing or adapting it later became expensive and slow. That made long-term commitment feel heavier because mistakes could not be corrected easily if assumptions changed. In faster systems, risk was accepted up front, but flexibility allowed recovery when plans went wrong. In Europe, risk was minimized early, but rigidity made later correction far more difficult. This trade-off quietly changed how attractive Europe looked for future-oriented investment. Capital did not see Europe as unsafe, but as a place where time moved differently than the rest of the world. Time matters to money because delays compound costs and reduce the value of long-term returns. As a result, Europe became a place to preserve wealth rather than grow it aggressively. Preservation attracts some capital, but growth attracts far more over long periods. When growth opportunities moved elsewhere, Europe kept what it had, but lost what it could have built. This is how stability slowly became a trap without anyone intending that outcome. The system protected the present so well that it quietly limited the future. People inside the system adapted without protest because adaptation felt safer than disruption. But every adaptation reinforced the same direction toward caution and slower momentum. Over time, this direction became the default, even though no one voted for it. That is how a system can feel fair, orderly, and stable, while quietly falling behind. And once that gap opens, closing it requires choices far more uncomfortable than maintaining stability ever was. Europe's story is not about collapse or failure, but about what happens when systems choose safety for too long and forget how to renew themselves. Nothing broke suddenly, which is why the consequences spread slowly and felt confusing rather than alarming to the people living inside the system. Capital did not punish Europe. It simply followed incentives toward places where the future felt easier to build and adjust. That choice reshaped opportunity long before it reshaped headlines because money moves years ahead of public awareness. By the time the effects became noticeable, the decisions that mattered most were already locked in elsewhere. This is the danger of quiet change, because it removes urgency while permanently narrowing future options. Europe preserved stability, but stability alone does not create momentum once the world around it speeds up. When growth becomes something to manage instead of pursue, ambition slowly gives way to maintenance. History shows that systems rarely recover momentum by accident once this phase begins. They either accept long-term slowdown as normal or make uncomfortable changes that challenge everything built for comfort. Europe has not reached that decision point yet, which is why the story still feels unresolved. But the lesson is already clear for anyone paying attention to how capital behaves. Money does not wait for permission, debate, or consensus before choosing its direction. It moves quietly, early, and permanently once confidence shifts. That is why the most important changes happen when everything still looks fine, not during crisis, but during calm. And by the time the calm feels uneasy, the future has already chosen a different path.